Yes, you can be making money and still getting poorer. That's what happens when inflation rears its ugly head. So we're going to talk about how to beat inflation, but first we're going to talk about what these forecasts say, that inflation is going to be with us for a long time. So you got to get into this fight right now, and you've got to get your money working hard for you. Otherwise, you're going to lose to inflation, and you're going to turn around and you're going to be on a hamster wheel, because you're really not going to be getting wealthier. You're not going to be headed toward economic independence. You're going to be running in place. Hey, MCE crew, I hope your day is progressing profitably. So let's get ready to talk about higher inflation is here to stay for years. Economist forecast. This is a story we'll link to in the description. It is in the Wall Street Journal. We do have a video on how to read the Wall Street Journal. It's our most watched video. Check it out. And you know what? If you know anyone at the Wall Street Journal who'd like to sponsor us. All right, higher inflation is here to stay for years. Economists forecast strong economic rebound and lingering pandemic disruptions fuel inflation forecast above 2% through 2023. Survey finds. Now, let's talk about that first line. Above 2%. That could be 8%. I don't know. We'll get into it. Through 2023. Okay? Could be longer. So, let's see what these guys are talking about. Americans should brace themselves for several years of higher inflation than they've seen in decades, according to economists who expect the robust post-pandemic economic recovery to fuel brisk price increases for a while. Economists surveyed this month by the Wall Street Journal raised their forecast of how high inflation would go and for how long, compared with their previous expectations in April. So what's this going to look like to you? It's going to be multifaceted. First of all, you've got to pay yourself first, but you've got to eat. You've got to buy clothing. You've got to buy gasoline, appliances, on and on and on. We're going to see increases across the board. If you see increases in fuel prices, you're going to see increases in every other product you purchase because everything is transported to your home or to the store by something that is motor driven, something that takes fuel, whether that be a cargo ship out of China or some sort of airplane, a Amazon Prime van, or your car going to the store to get it. Okay, so everything works off of that. The other thing is, if we see increases in the corn prices, as well as the fuel prices, and I'm going to tell you in a minute why that's probably going to be a 1-2 combo punch, then corn is the basis of our food chain. Chickens, pigs, cows, they all eat corn. And as such, that's going to raise the cost of feeding them. Now, one of the reasons why you might see this 1-2 punch of corn and fuel prices increasing is because a lot of our fuel in this country is corn-based ethanol. And if you're taking more corn off of the market to help add in this ethanol to gasoline, then that supply of corn shrinks, thereby making it more expensive. Okay, follow me on that. So this is what we're looking at. Okay, so they say that would mean an average annual increase of 2.58% from 2021 through 2023, putting inflation at levels last seen in 1993. Quote, "We're in a transitional phase right now," said Joel Naroff, chief economist at Naroff Economists LLC. Quote, "We are transitioning to a higher period of inflation and interest rates than we've had in the last 20 years. Now, I want you to remember, because a lot of people are still stuck on trusting the government and trusting the news media. For 18 months, Janet Yellen, the Secretary of the Treasury, and Jerome Powell, the Fed chair, the Federal Reserve chair, were both out there. Every time they got asked a question about inflation, they almost laughed it off. They said it was nothing to worry about. Now, if you've taken a simple high school level macroeconomics class, you know that when the government puts a lot of money out on the street, then we will see inflation as a result of that. Okay? Now, I don't need to be an economist or work over at the Department of Treasury to be able to understand that. So, your government was out there lying to you in order to prop up the stock market. All right? And the stock market falling is not necessarily a bad thing if you are a long-term investor. All right? It may very well be an opportunity for you to buy after doing your due diligence. We'll continue. The inflation measure, the Commerce Department's core price index of personal consumption expenditures, jumped 3.4% in May from a year earlier, the biggest increase since the early 1990s. What Mr. Nerov and other survey respondents describe is a general shift from the lower inflation of the past 2 decades, a shift that could create new challenges for households, policymakers, and investors who came to expect inflation closer to or below 2%. So, what does this mean for the money you're putting to work for you? Well, as we have always said on this channel, we have always taken a look at inflation from a historical perspective and have always said your money needs to do better than 3%, because when you look at that table of historical inflation, it runs 2.5 to 3% on average. So if your money is out there working for you and it's not getting 3% return, at least, that's just the, keeping pace with inflation. If it's not doing that, then the value of that money is decreasing. If the economists prove correct, Federal Reserve officials might have to raise rates sooner than they expect to keep inflation under control. Now, if they raise rates, what that's going to do is it's going to give the stock market a temporary hit, and you're going to see some declines because the entire country has gotten used to inexpensive money. These interest rates have been low. It has fueled the real estate market. It has fueled easy access to credit. And we're seeing now that whole paradigm is changing. Now, let me pause right here and give you kind of a really easy way to understand inflation. I know you have that older person in your family who has invariably, or maybe you have said this yourself, when I was young, I could buy X for Y. Okay. In my case, I always take the example of a bottle of Coca-Cola. When I first started being able to make a purchase on my own as a kid with my allowance, Coca-Cola cost 60 cents. Okay? Now, if I were to take that same 60 cents to 7-Eleven right now and try to purchase one bottle of Coca-Cola, one 20-ounce bottle of Coca-Cola, they're going to say you need more money. Why do I need more money? Because the value of the dollar has fallen since the 80s when I was, a young guy out there with an allowance. The value of the dollar has fallen such that it takes 40 more cents to purchase. Actually, a bottle of Coca-Cola is $1.20. So it takes 60 more cents. So that's almost, double. That is double the price. It takes 60 more cents to buy some Coca-Cola today than it did when I was coming up. So that shows you how inflation works. Now, when we look over the long term, you really get, the picture very clearly. But inflation is slowly chipping away at the value of your dollar. That is why you have to beat inflation. The Fed's preferred inflation gauge, the overall PCE index, which includes food and energy prices, rose 3.9% in May, nearly double the central bank's 2% target. The Fed, in a report released Friday, repeated its view that inflation has picked up this year due to bottlenecks, hiring difficulties, and other, quote, largely transitory factors. That's the new word that they're using, transitory. Oh, it's not here to stay. Inflation is just, it's going to evaporate one of these days. Well, these guys are saying that we can expect this at least through 2023. All right, so that doesn't sound transitory to me. Most officials in projections released last month believed inflation would decline to around 2% over the next 2 years, though there was greater uncertainty over how quickly they might need to raise interest rates to get inflation there. So the Fed can try to control inflation by raising the interest rate. When you make it more expensive to access capital, then what you're going to find is it's going to cool the economy off, okay? If it costs more for you to go out and get a home loan, then that's going to put some people out of the market. They're going to say, no, I'm going to stay where I am. Same thing with cars. They're going to say, hey, let me back up a little bit and wait. Credit card balances. People are going to say, whoa, these credit card balances, these credit card interest rates are going up. Let me back up a little, take a breather, and pay down some of this debt instead of purchasing more. All those things have the effect of helping to stem the tide of demand, which in return stems the tide of inflation. So that's what's going on out here with inflation. They're now, we're seeing more and more talking points out there about, the fact that yes, we are going to be dealing with inflation. Now, as time goes on, I'm going to tell you, I fully expect them to raise their expectations for the amount of inflation. So have your money working hard for you. You have got to get out there and find things in the 6, 8, and 10% range. Remember, we talked about your own business. That's the asset class with the highest return potential. Mind you, it's got to be a well-run business in an industry that actually, has decent profit margin and all that good stuff. But according to the Small Business Administration, 15 to 30%. Those are the returns you can expect from a well-run small business. Now, that would do wonders to help you beat inflation. We're going to talk a lot more about this, guys. All right. I'll talk to you soon.